Welcome to this explainer. Every single bond you've ever seen, whether we're talking about a US Treasury, a UK gilt, an Indian government security, or a corporate bond, probably looks like a really simple, straightforward investment. You buy it, you collect a bit of interest, and you get your money back at the end. Simple, right? Well, actually, scratch that, because that is not what professional investors are actually buying. Today, we're going to descend way beneath the surface of global finance. We're going to uncover how static debt is, in reality, a precisely engineered machine that quietly moves trillions of dollars across governments, corporations, pension funds, and the entire global economy. So let's dive right into this by asking a pretty compelling question. If bonds are simply promises to pay money over time, why in the world do the largest institutions on the planet treat those future cash flows as one of their absolute most valuable assets? Before we completely unpack the mechanics of this massive system, please note, this explainer on the channel Blocks Bonds Funds is created for educational and informational purposes only and does not constitute financial or investment advice. All right, let's get started with Section 1, the hidden blueprint. When we completely strip away the illusion of a simple investment, we find that every single bond out there converges into one universal design. It's essentially supported by three fundamental structural pillars: face value, coupon, and maturity. Think of these three things as the actual DNA of the global debt market. Honestly, no matter who issues the bond, these geometric building blocks dictate exactly how the money is going to flow. Let's look a little closer at that first block. The absolute crucial point here is that face value, or par value as you might hear it called, is the exact contractual repayment amount at the very end of the bond's life. It literally forms the foundation of the whole contract, and it's absolutely critical to understand that this face value is totally distinct from the bond's daily fluctuating market price. Whether the bond is trading at a huge premium today or a steep discount tomorrow, that face value is the hard, mathematical promise of what you get at maturity. Moving on to the second pillar, we have the coupon, which is your income generator. This is fascinating because it evolved from physical paper slips that investors used to literally clip off their certificates into these glowing, highly predictable digital cash flows. And they take on very specific patterns. You've got fixed rate bonds where the payment stays totally constant. You've got floating rate bonds that automatically adjust with market reference rates. And then you have zero coupon bonds that pay absolutely no periodic interest, but are instead issued at a massive discount. It's all about engineering a very specific stream of income. And the third pillar is maturity, which expands across a timeline. This is basically the repayment horizon, and it aligns the financing perfectly with the actual real-world projects it's funding. So you might have 91-day Treasury bills used for short-term government cash management. Then you have 2 to 10-year notes for medium-term needs. And this goes all the way out to 10 to 40-year long-term sovereign and corporate bonds. This is exactly how multi-decade infrastructure builds are brought to life in the real world. So how does this all come together? Well, it builds into a master formula, the present value of a bond equation. It brings our three pillars together as the core inputs. Treasury teams, investment banks, regulators, they all use this because it's like a giant puzzle. When you shift just one of these three variables, you completely change the pricing, the yields, the duration, and the risk. This single equation is the engine translating future promises into present-day billions. Let's move right along to Section 2, scaling up to trillions. With the foundational engineering out of the way, let's explore how this blueprint scales up. We are moving from the anatomy of a single bond to the circulatory system of the entire planet. Take the Indian government securities market, for instance. This single sovereign market alone acts as a massive standardized network circulating over $1.2 trillion. That is a mind-boggling amount of capital flowing through custodians, depositories, and exchanges. And it all functions flawlessly because it adheres strictly to that same blueprint we just broke down. And it's definitely not just one government doing this. Capital is continuously flowing between an incredibly diverse array of issuers and investors. We're talking US Treasuries, UK gilts, which, by the way, boast a zero default history, and massive corporate bonds from giants like Apple, Microsoft, Tata, and Reliance. They are all linked through the exact same architecture. Governments and tech giants alike are tapping into the identical standardized network to fund their operations. Let's look at a really concrete example to put this into perspective. Consider Reliance Industries' massive $4 billion jumbo bond issuance back in 2022. They didn't just borrow one giant lump sum. No, they engineered specific 10-year, 30-year, and 40-year buckets, also known as tranches. By structuring these with very competitive interest rates compared to U.S. Treasuries, they turned their debt into an incredibly efficient long-term funding tool. This is exactly how you strategically shape cash flows for a global conglomerate. Okay, let's get into Section 3, the invisible legal framework. Because here's the thing, a machine this powerful, moving literally trillions across borders, needs absolute ironclad safeguards. You can't just promise future cash flows, you have to legally enforce them. This invisible legal framework is made up of vital protective layers. You've got trust deeds that outline the contractual terms, the prospectus that discloses the risks, trustees who act purely on behalf of the bondholders, and covenants, which are basically strict rules restricting what the issuer can do. These layers wrap tightly around the contract to ensure those obligations remain completely secure. Now, within this strict legal setup, you've got to realize that not all debt is created equal. Secured debt takes absolute priority in the capital structure by locking in specific collateral or assets, meaning if things go terribly wrong, the bondholders actually have a direct claim on that physical property. On the flip side, unsecured debentures rely entirely on the overall financial strength and general creditworthiness of the issuer. So understanding exactly where a bond sits in this legal hierarchy is just as important as knowing its interest rate. As a single bond transforms into these glowing rivers of scheduled payments flowing across continents, one really profound realization begins to emerge. The true product isn't the bond itself. It's the predictable flow of money hidden inside it. Billions of these contracts ultimately connect across the earth, directing trillions into building modern human civilization. From the bridges you drive on every day, to the hospitals that heal us, to the airports, research centers, campuses, and power grids that light up our cities, it is all funded by the precise engineering of these cash flows. So, I'm leaving you with this thought today. Now that you know how these precise cash flows literally engineer our entire world, will you ever look at a bond as just a simple piece of paper or boring static debt again? Or will you now see it for what it truly is? One of the most powerful money machines ever created.